Welcome to On Investors' Minds. I'm Jennifer Qiu, the Global Market Strategist with JP Morgan Asset Management. I'm very happy today to be joined by Kerry Craig, our Global Market Strategist based in Melbourne, the alts experts on our team, as well as Gary Leung, Head of Alternatives for APAC Clients. Welcome both.
Thanks, Jen. Great to join you today.
Now, the US election results have brought about prospects of, on one hand, stronger growth and deregulation, but on the other hand, concerns over US debt sustainability, as well as tighter immigration controls and higher tariffs, etc. While the potential public market impacts are pretty well known, what are the impacts on different alternative asset classes? And how can alternatives help us navigate this new policy environment? So today I'm very happy to have Kerry and Gary here to shed some light on these two questions. Kerry from a top-down perspective and Gary using a bottoms-up lens. Now, let's start with real assets. One major market reaction to the elections was the expectations of a shallower Fed cut cycle and a higher for longer long-term yield due to higher deficits, inflation risks, etc. What does this yield backdrop mean for real estate? And how does President-elect Trump his policy stances on growth and on immigration, etc., impact real estate? Kerry?
Well, I mean, yeah, it's a very topical question, obviously, and we can look towards the private markets as moving a little bit more slowly in terms of how they sort of grapple with this outlook in terms of the Republican sweep, where public markets pretty quick to readjust how they've priced in what may happen in the coming years under the new Republican administration. But we can look at the broad suite of policy announcements we've had and sort of say, well, typically they're quite pro-growth, and all else equal, if they do see an economy that's expanding faster, this should be quite positive for real estate and thinking about the performance of that asset class in terms of the private real estate market. Now, it does come back to thinking about the starting point we are in real estate, and quite frankly, it's on a pretty solid basis. One way we can look at that is by vacancy rates. If we take the different segments within the real estate market, starting with industrial, we can see that those vacancy rates are about half of what they are in the long-term average. So pretty good. Most of it's being used to its capacity. A lot of that's driven by what we've seen in terms of e-commerce over a number of years and thinking about the demand that has been there leading to those lower vacancy rates and obviously feeding into that as being a strong performing asset class within real estate. But even across those other segments, if we think about obviously retail or even apartments, their vacancy rates are roughly in line with their long run average. So again, a pretty good starting point for thinking about where we're heading from here in terms of performance of those assets. The one that always stands out, though, and the one that obviously comes up the most when we talk to clients about the real estate segment is office. And it is an area where we are seeing some improvement. And it does feel like, I guess, the worst may be behind us, but it's very difficult to think about exactly where we may be in terms of finding a bottom on some of the pricing in this part of the real estate market, particularly in the US more than other places around the world. And it is very much a divided market when we think about the different performance of assets within the office space. So it's the age of buildings, it's their locations, it's the amenities they offer that really dictating the price and whether transactions are going through or not. So on that basis, it does feel like the very high-end trophy assets are being well priced. They're the ones in the good location. They have newer buildings. They achieve a lot of the tenants' requirements around the amenities that are on offer. Whereas, the other spaces where they're slightly further away from the best locations, maybe slightly further away from transport links, pricing is a little bit different there. That does create the opportunity when we think about more opportunistic and value add that comes through there rather than thinking about the very prime end of the market. So I think that the real estate is going to be extremely interesting from that perspective in terms of finding that bottom, offering that bit of value that can come through. And again, being an asset class that should do quite well if we do see the economy in the US continue to expand, which is our base case. Not fly in the ointment, but the thing we do watch more closely, and coming back to your point around if we get all this fiscal policy, what does that mean for the outlook for rates? If there's that concern about debt sustainability, where does yields go? What do we think about funding costs? We can go back a few years and look at what happened in terms of the fallout from some of the regional banks, the concerns around commercial real estate lending. And obviously it depends on which side of the ledger you're sitting on. Are you thinking about it from a borrower or a lender perspective when you're approaching the real estate market? And this is where we would sort of watch closely the dynamics that are going to play there if there is a higher financing cost come through, depending on where you sit in that ledger. I think there is still an opportunity here, though, that comes through, because if you do see more stress or distressed opportunities around the sort of credit side of real estate and the lending side, again, there's an opportunity for those with fresh capital being able to step in and maybe picking up some good deals on the private lending side of the real estate, not just thinking about the ownership of the physical assets. And then finally, the other policy that obviously comes to mind, moreover, is migration. Obviously, that's a big one that's been positive for the US economy. We're thinking about what it's done to the supply of labor, offset a lot of those concerns around increasing demand that we saw, and sort of leveling the playing field when it came to that supply-demand imbalance, and obviously easing some of the inflationary concerns that get driven by wages. But also the thing that we looked at and said, we've got this increased supply of labor. If you have this positive net migration over the last couple of years into the US, that's creating a lot of housing demand, and that's obviously boosting the prices we've seen across the housing segment in the US as well. The concern there is that demand will fade if you do see these very strong migration policies that come through. Now, again, there's a lot of uncertainty around what that actually may look like. And I think more fundamentally, when we look at, say, the residential housing market in the US, it's not really a story of demand. Certainly that's part of it. But the story there is really about just the undersupply of housing in the US for a number of years, really, starting off from the GFC, the ability to find workers, the ability to find builders and tradespeople to actually build these houses, the zoning laws that have made them relatively restrictive in terms of preventing that supply of housing coming through. And that's going to take time to remedy itself. So even if there is perhaps some softer demand from the migration side of things, it's really that undersupply of housing in the US, which is driving the outlook for that part of the market. And again, something we could see continue to perform quite well, given it takes a number of years for that supply and demand to come back into balance. And again, if we do see interest rates coming down in the US, we might see that flow through into more housing market activity more broadly, as people have largely been sitting on their hands, not wanting to refinance their mortgages at higher interest rates, which is something the US can benefit from relative to other parts of the world.
Thank you, Kerry. How about Gary? What are you seeing on the ground now?
I agree largely with Kerry as well, but I want to add a couple more points to this to actually complement his views. Number one, on the commercial real estate side, that's what we're seeing, right? In terms of the transaction volumes and also values are actually bottoming out. And in fact, transactions has been up 35% since 4Q 2023. So that is actually an encouraging sign. And the other part is some of the effects of COVID. So think about the work from home, etc., is slowly fading away. So a lot of corporates now are actually requesting their employees to work in the office for certain days in a week. So in fact, we've seen solid return of demand in the real estate side. So therefore, combining with Kerry's point of where we are in pricing today and potentially where we are going in rates, in fact, we are seeing a generational buying opportunity for real estate, especially commercial real estate. So JP Morgan has over 60 years of experience in real estate investing. We're one of the leaders, in particular for the US. So think about the network and the data that we have today is very much representative of what we're seeing in the market. And also confirmed by our long-term capital market assumptions as well. So that's also confirmed. This is also one of the very strong buying opportunities for the long term.
Thank you, Gary. That's very compelling. Now moving on to infrastructure. So President-elect Trump has been quite vocal about wanting to dismantle President Biden's Infrastructure Investment and Jobs Act, the IIJA. And there's also the Inflation Reduction Act and other climate infrastructure projects that could be at risk. But at the same time, some expect his push for deregulation could speed up constructions and repairs, etc. So, Kerry, let's start with you. How do all of these dynamics impact your outlook on infrastructure?
Yeah, it's another one where you think about the broad sways of these policy and the direction they're going, and really need to see a lot of the detail around, as you mentioned, what might be deconstructed in terms of those policies and what might be kept. And there's some areas we could focus on and say, well, some of the subsidies for electrifications of grids or for renewables may be taken away. But there's other areas we think it's, again, a story of a very long-term trend that we're seeing in the US and around the world. And that is the nature of infrastructure investment. We're thinking long term. And that's why it leans itself so well to the private markets, because it's something that needs to sort of attract long-term capital. It can't be flighty capital that comes in and out with public markets or being subject to quarterly earnings reports and that kind of thing, because of the long nature and the build-out that's required. So, while there is some concerns around what may happen to those different legislative pieces that are being put in place, obviously it's going to be taking time to unwind them. And in the meantime, some of those funds have actually been allocated into the economy and have been put to work in terms of building out some of this infrastructure. But it goes back to a larger point around, what we've seen in the US and other places around the world is that there's been, a willingness for governments to want to spend more and use their fiscal capacity to support growth and build infrastructure, whether it's to achieve some of those renewable goals. But that sort of contrasts with the ability to do so. And that's particularly in the US. So if you simply look at the Congressional Budget Office forecast for the debt profile for the US, if you add in some of the policy initiatives we've heard from the Republicans, you quickly get to a debt to GDP ratio of over 140% by 2030. And that's not as high as other markets around the world, but that's very high in the US historical context, and much higher than it was post World War II when they were doing all that rebuilding for basically reunification of the US and rebuilding out of Europe. So that does create a headwind. Deficits will rise as well. So the ability for the government to continue to fund these projects becomes a question, but it also, again, becomes that opportunity because of that long-term nature of that investment. It just opens the door to seeing more private capital being put to work in this area, and as a source of demand for consistent income streams that you get from these kind of projects. You get non-correlated assets, you get things that can complement sort of fixed income in a portfolio and provide that diversification. And those are the reasons why we see this as being still a very attractive area when thinking about portfolio construction, asset allocation over time, but it does come with that longer lead time and some of those liquidity constraints that investors may need to know about. When it comes back to thinking about the actual policies themselves and the ones that may change, I just put it in context of saying that there are different estimates available, but one that we focus on is the fact that there's a need or an estimated need for about 12 trillion US dollars in infrastructure build out in the US by 2040. That's a very big number. That is really creating that demand that's there and our ability to put that capital to work, because we often hear this is an area where there's a lot of money being allocated to that conflicts with the pricing of the deals and you're overpaying for the opportunity. And that's just simply not the case. There's going to be a huge pipeline of infrastructure available for investors to be involved with. And we do think this is going to be a pretty consistent sort of asset class in terms of performance, given the very smooth profile that we see come through from that income generation side of things. When it comes to the themes that we think are important, obviously there's a few there. It's about the electrification of national grids. It's about the demand that's being created by data centers that's coming through. It's about broader decarbonization of the economy. It's just the ability to generate electricity for rising needs of demands in the US. And I think this is something that's going to play through consistently, and it's going to lean itself more towards those renewables relative to fossil fuels, given, just the lower cost of production that comes with that. Just the simply thinking about the demand for EVs, it's going to power that, the demand for AI, and how data centers need to be built and they need to be funded through both water to cool the processing and also electricity to drive them forward. So there's these different dynamics at play. So while some of those policy initiatives we're hearing about and some of that rollback of what things have been put in place may impact those subsidies and could have have particular impacts around certain areas, I think the longer term trend is that the demand for electricity, particularly in the US, is rising. And if we play that through that decarbonization theme as well, you're going to see ample opportunity to invest in these areas over time. And again, the final bit of that policy initiative side of things is that we hear about it from the federal level. When you're investing in things that generate electricity, it's often coming through at the state or local level, and there can be different rules and regulations in place that are very different from what the federal government is doing and how that money and subsidies are actually being used, which is, again, something to consider when you're thinking about allocating towards infrastructure, taking advantage of some of these themes that are playing out in the very long-term nature of what we see changing in the US and global economy.
Thank you, Kerry. Gary, what are you seeing from a bottoms-up perspective? Are there any sectors that you favor given this very uncertain market environment we're entering?
For the bottom up, we actually look at the entry point of infrastructure. As opposed to listed, we preferred private non-listed infrastructure, because there are two potential benefits there. Number one, they're not subject to the market movements, which equity market in particular has been very volatile. And secondly, if you're investing into private infrastructure, that's where you get access and actually control of some of these assets that are needed to be value added. And then the other part is sectors, as you mentioned. I think investors should also broaden out from what Kerry has mentioned, what we call fixed infrastructure. For us, we're looking also at transportation assets, and we define them as mobile infrastructure. So think about what is mobile infrastructure. So these are assets that moves goods around the world. So think about like our electricity grids, gas, water pipes. They move certain commodities from one place to another. And transportation, they move goods, they move gas, they move others, right, to all places around the world. So for us, JP Morgan actually is a top 10 ship owner in the world. So in fact, I think we're eligible to share some dynamics here as well. So if you think about shipping, right, we will focus on the core transportation asset investing. So what it means is that we will buy the ships at inception. So i.e. we build them and we hold them to the end of its usable life. So we don't really trade ships and all that. As you can see previously, there are different ship cycles and all that. We're not susceptible to that. So all we need to do is, just like infrastructure investing that Kerry mentioned, if we find a good counterpart, a good offtake, a good lessor for our assets, then we'll be able to get very stable market uncorrelated income from leasing. So what we're seeing now, transportation asset, some people may say that there are a lot of risk around the world, geopolitics, wars, etc. But we actually see transportation assets as a hedging of these risks. Let me give you a few examples. Number one, we're seeing change of supply chain around the world. So ever since COVID, a lot of producers have moved away from China to other parts of the world. Think about Southeast Asia, where there's no existing roads or infrastructure that actually transport these goods. And the only way they could do it is actually through ships. So demand for us actually has been on the rise since then. And it's going to continue. And the other part, Russia and Ukraine. Think about the war that they have in here. And Russia has been one of the largest supplier of gas to the Western Europe. So what we're seeing now is that those pipes are no longer supplying. So in the Western Europe, where are they going to get the gas from? They're going to get it from the rest of the world. And how are they going to be transported? By LNG tankers. So the other one is Middle East conflict. So think about where we are now. The Red Sea is now what we call the red zone. It's going to be very hard for transportation assets to go into that without being subject to the risk of being hit by missile. But what we're seeing now is that a lot of these ships are going around Africa. But at the same time, they still need to meet shipping schedules. What it means is that they're going to lease these ships for longer, and they need to lease more ships to ship more goods around this longer route. So in fact, for us, as a core investor in transportation assets, in particular for vessels, this is absolutely beneficial for us.
Thank you, Gary. Really reminds us of the diversifying role that alternatives play in our portfolios. So now let's shift gears to our last part, so the private market. Let's do private equity market first. So how has the private equity market been doing so far, and to what extent can Trump's policy reinvigorate this market? Kerry, let's start with you.
The private equity space has been challenging for many investors, given that the exit market has largely been closed. There hasn't been a huge amount of IPOs. There's been a mismatch between buyers of these assets at very high multiples, not willing to let them go at lower ones that they're being offered. So that bid-ask spread has been very wide, and so it's been difficult to really assess prices in the markets for these deals, to really see a pickup in transaction volumes, which has been very low in the primary market. And again, just the nature of it being quite constrained. So again, here, thinking about the broader sort of implications of what we're hearing around deregulation, thinking about the ability for more M&A activity to take on, tax cuts to come through to lift profits and revenues and just the earnings outlook for potential acquisition companies. All that's quite supportive for thinking about an improvement in M&A activity, an improvement in exits that could help the private equity market. And simply just the removal of that political uncertainty should be something that would be quite buoyant for the private equity side of investing. You've already seen it come through on the public side, by all means, given the rally we've seen in the US market this year. I think there's still a couple of things to be mindful of here, though. If we look at valuations, yeah, they've come down. Higher interest rates have had an impact on debt multiples, so you've seen those come off. They're still at not super cheap levels, though, so I think that's again reflective of the fact there isn't a lot of transaction volume coming through to really get an adequate gauge on pricing. And there might still be GPs out there sitting on assets they've paid a lot of money for, not willing to let them go at lower multiples. So you're seeing more use of things like continuation funds, like these assets being rolled into other vehicles to keep them going, and that largely happens through the secondaries market. So again, we think about the PE side of things, there's obviously the use of leverage. Those lower interest rates coming through could be quite meaningful for those thinking about big LBO leverage buyout deals and seeing that support come through there. The ability to take companies public, that being something that's becoming more meaningful in the future. But we do have that question mark around just how low rates can go. If the Fed is concerned about stickier inflation, that could constrain that to some extent. And so you might still see that activity in the secondary market being more beneficial and more meaningful as investors are looking at a way to actually create that liquidity, to get those distributions back, to roll into new funds, and something that's been locked up and becoming an area of greater importance in how the private equity space actually operates. So for us, it's still a case of being a little bit cautious around the private primary side, seeing some improvement there. But again, focusing on the fact that you have this growing secondary market that's becoming more important to the sector overall, and the opportunities that are coming through there in terms of the ability to create that liquidity, to pick up deals at discounts to NAV, and create that upside to returns overall. So again, as much as the private equity space is related back to what we're seeing in the public equity side of things, the development of that secondary industry is still a keen focus for thinking about investing in this space, and still watching about how that leverage may play out, given that rates may not fall as far as the market currently expects, given some of those concerns around growth and the stickiness of inflation.
Thank you, Kerry. Gary, so we have a very experienced private equity group. So what are they seeing on the ground, and what are your client conversations like nowadays around private equity?
Thank you, Jen. So the group actually has been around for 40 years. They've been investing in the middle and small cap market space during this period. And if you think about that, what we're seeing now is, I think, I look in both the leverage source side and also on the deal activity side. So on leverage, what we're seeing now is the use of leverage has changed from sourcing from a bank to sourcing from private credit firms. In particular for the small and mid-cap space, where we're seeing banks are retrenching from this space, they're becoming more risk-averse. So in fact, a lot of these private credit funds have become very prominent in lending to these small and mid-cap companies. And the other part is on deal activities, we see deals continue to focus on the AI segment. So if you think about AI, so we've seen different models emerging, OpenAI, XAI, etc. They have raised capitals, different rounds of capitals in the past year. What we're seeing now is this will continue. And in fact, we might see some consolidation in the long term. That's going to happen as well. And the other part, actually, in the concern of a private equity industry has been the distribution side, which is what Kerry has mentioned, liquidity. So we measure this by DPI, which means distribution to paid-in capital ratio. If you think about this, if you invest in private equity fund, the deal underneath will need to exit for capital to be returned to investors. But with the lack of IPO that Kerry mentioned, what we're seeing is distribution has been very low for the past 3 to 5 years for that reason. In particular for the large cap space, because the route of exit could only be IPO or selling to a very large strategic investors, which there are not many around. However, that's why I think our advantage of sticking to the small to mid-cap space become very resounding in the last few years, because being a smaller company, you can always sell to the large cap private equity funds. And you can also sell to the smaller strategic buyers. But also, you can also IPO as a smaller deal. So in fact, our exit route or our exit activities comparing to the large cap funds, for us, has been business as usual. And in fact, our distribution ratio compared to large cap funds, right? Like we are at least double of what they are in that DPI. And the other part is, if you think about the IPO, what we're really seeing is that now, in particular to large cap space, there are a lot of deals stuck in the pipeline today, waiting to be exited. And in fact, a lot of pressure driven by the fund terms, the investor needing the capital back. So if you think about the IPO market, it's going to be very crowded potentially if the market recovers, the rate and all that becomes more favorable. But then the key is, what valuation can they attain because of the abundance of IPO deals available? So in fact, how the investors' appetite on the public side and also the deal type that they go into IPO is going to be critical of what valuation they can attain. So we're going to see this bifurcation in valuation. And so the other part is, I think lastly, I just want to share with you, just if you think about the alpha generation in the small to mid cap space, it's actually more consistent compared to the large cap space because of the less dependencies. So some people may think that this is more the public market standpoint. They think that small cap is a bit more volatile, a little bit different, but the private equity space, small to mid cap is actually its natural place because initially what private equity capital has been used for is actually to support these small and mid cap companies to grow. So if you think about that, for us, our focus, our team's expertise actually suits this market very well.
Thank you, Gary. That's good to hear. So that's a wrap for our episode for today. Thank you, Kerry and Gary, for your time and for all your insights. I guess just as a conclusion, we can see that there is still a lot of uncertainties and risks as we head into the new year, but some of them certainly represent opportunities for different alternatives asset classes. But of course, we often tell our investors not to position portfolios solely on policy speculations and expectations. So it's still important to remember that regardless of how the policy landscape shifts, alternatives as an asset class can continue to provide diversification, steady income, and an inflation hedge, perhaps now more important than ever. So with that, thank you once again to our speakers, Kerry and Gary. Thanks everyone for listening in, and we'll see you next time. Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.